Good afternoon, everyone. My name is Max Clark, and on behalf of the Fox Alliance, we are grateful that you've chosen to spend a few minutes of your afternoon with us today. We are hosting this webcast titled The Journey to Receivership, where we're going to be really discussing what happened with the Silicon Valley Bank, which was taken into receivership by the FDIC just a little over a week ago. It's something that has really created a lot of tumult in the banking market specifically, but also the broader financial markets. We'll be taking a look at what led up to this situation, kind of how those tumultuous 48 hours unfolded, and what those likely implications are for us going forward. We will be taking questions at the end of the conversation, and you can send any questions that you have directly to my email address, max@the-Fox Alliance. Given the regulatory environment that we find ourselves in, we are unable to use the Zoom question feature. So if you'd like to ask questions, please go ahead and send those to my email there on the screen. Josh Renfro, who many of you guys know as one of the partners here at the Fox Alliance, will be walking us through everything that's going on here. And he will also, of course, be available for questions in the end. Josh, I'll go ahead and turn it over to you and take it away.
Thanks, Max. Appreciate it. As Max mentioned, this is a period of intense drama in the banking sphere, specifically considering the fact that we've not had a major bank failure since 2008. And so we really want to take you guys through the steps that led up to this moment, what actually happened, and what we think the likely fallout will be. So let's start off with the setting of the stage. Silicon Valley Bank, first, who are they? Silicon Valley Bank was a bank that wasn't known by probably many of you up until about 2 weeks ago, but they have predominantly risen in prominence because of their connections with venture capital related businesses in the Silicon Valley area. And as a lot of those companies grew in prominence and grew in wealth, so did Silicon Valley Bank's success. And so, and that has been even more pronounced over the last several years. We specifically see that first with the rapid rise in deposits that Silicon Valley Bank had between 2018 and 2021. Their deposits went from just shy of 50 billion to just shy of 200 billion at the end of 2021. And that is a very large number. That's not a rise that you typically see in a large number of banks. So that's one of the first things that set the stage for what happened last week. The next thing was looking at Silicon Valley Bank's actual balance sheet. So you'll notice here, Silicon Valley's balance sheet had about $203 billion or so of total equity. And then on the liability side, they had customer deposits of $173 billion. This is as of the end of 2022, and then about $22 billion of other debt on their balance sheet. The important thing to note here, though, is specifically look at the amount of money in available for sale securities, cash, and other. In those numbers, we're talking about $43 billion of actual liquidity that the bank ultimately ended up having. The other thing that you need to be aware of, specifically with this $26 billion, is that the majority of that money sits on the balance sheet and came in during that massive inrush of deposits that we saw in 2021. And we'll kind of talk more about why that's significant here in a second. The next thing that's important to understand about this particular situation was 97% of Silicon Valley Bank's deposits were not insured by FDIC, meaning most of their deposits were above the $250,000 threshold. Now, where does that stand compared to some of their compatriots? You look at JP Morgan as an example. Theirs is still pretty high at almost 60%, but you have some other banks like Bank of America, Goldman Sachs, where that number is much lower at like 33%. Why is theirs as high as it is? It's predominantly because of two things, because there's only two ways it can be that way. Either one, you have large business clients where they've got, a couple $100 million or tens of millions of dollars that are deposited, and so a very small percentage of those deposits are covered by FDIC. And then the second way that's possible is if you're serving a lot of ultra wealthy clients, either one of those two. And in Silicon Valley Bank's case, it was both of those things combined. And so that's another key thing just to be aware of as we're setting the stage. The last major thing in setting the stage was understanding what happened in 2022. As many of you know, we have been saying for the last 3 or 4 years, with interest rates virtually at zero, the only direction for them to move was up. And sure enough, in 2022, that's the direction they headed. We had a 4.5 percentage point increase in interest rates in 2022, the largest in 50 years. And we had another quarter of a point happen in the first quarter of 2023. This resulted in Silicon Valley Bank, when they finally did have to sell some of their bonds, they were forced to sell them at a loss because bond values go down as interest rates move up. The other phenomenon closely connected with that was in 2022, we saw growth stocks and specifically tech get crushed and the valuations come down. And as a result, that really disrupted the Silicon Valley Bank ecosystem. What do I mean by that? So Silicon Valley Bank, a lot of their clients are companies that are funded by venture capital. And a lot of people don't realize that that's a very different kind of banking relationship. So as an example, if I'm a startup company and I get $10 million in funding from a round of funding that I've raised, I put that money in the bank. I'm not adding new money to that. I'm using that money, I'm spending it down to pay for my expenses. And I'm not usually making a lot of profit or any early on. And so that money is getting drawn down. And so what happens is if I hit certain benchmarks, I'll go out, I'll raise another round of funding. Maybe it's more because the company's grown, maybe it's 15 million. And so my funding maybe is dropped to 5 million. From that original 10, I raise 15, I put it in there and I bring the money up to the same level or maybe even higher if the company is doing well. That kind of environment causes Silicon Valley Bank's fundraising to go in these roles, where for a period of time, the funding gets drawn down, and then eventually it gets added back to as additional funding was coming back to the table. Well, in 2022, that entire cycle got disrupted because there was very few venture capital funds that were raising a lot of money, and they weren't giving a lot of new money to venture companies themselves. As a result, the person who put that $10 million deposit wrote it down to 5 million, and there was no new money coming in, or at least very little. So not only did we have the bonds that these banks held as investments going down in value, but we also saw the deposits on the books also going down in value, which was eating into the liquid portion of the bank's balance sheet along the way. So that was another key thing. So let's walk through the timeline. On Wednesday, March 1st, Moody's contacted Silicon Valley Bank and announced that they intended to downgrade the bank's ratings. Another week later, on March 8th, Moody's, after meeting with Silicon Valley Bank, downgraded them from an A3 to a Baa1 rating. And they also put their outlook as negative, meaning the likelihood of additional drops was high. Silicon Valley Bank on that day announced the sale of substantially all of their liquid investments. So remember that chunk that I said was available in the event that people needed liquidity? All of that wasn't in cash was sold. And that is what resulted in a $1.8 billion loss from the losses on those bonds that had been longer duration. They had taken interest rate risk, and that's why they had that $1.8 billion loss. Now, one other thing that's important to note, this was not visible beforehand because of one of the rules surrounding how the Federal Reserve allows banks to report the holdings of bonds on their books. They can hold it at mark to market. They can also hold it at a yield to maturity, which basically is what I will get paid back if the bond, I get to hold it all the way to its maturity. The problem with that, obviously, is that if you need liquidity faster than you actually can hold the bond, you won't be able to hold it to maturity and you'll be forced to sell it. And as a result, the loss was unexpected to people. People didn't expect the Silicon Valley not to have hedged the risk on these bonds. Most banks do in a situation like this. So they were actually very greedy. This is the greedy and more risky portion of their operations. And ultimately, in my opinion, was one of the biggest things that cost them. Silicon Valley Bank also announced their intention to raise $2.25 billion to shore up their balance sheet that day. After hours, the bank lost 60% of its value as its shares plummeted. Thursday, things got worse. Depositors tried to withdraw $42 billion over the course of 4 hours. And just for perspective, Lehman Brothers in 2008 only saw about $10 billion exit, but that was over 10 months. So by perspective, this was a very fast bank run by comparison, $42 billion in the span of 4 hours. And at the end of the day, Silicon Valley Bank had over $900 million of negative cash balance because they didn't have the liquid assets necessary to actually fund the run. Friday, March 10th, the California bank regulators and the Department of Financial Protection and Innovation comes in and takes over the bank and puts them into FDIC receivership, downgrading them yet again from B, double A, lowercase, to C. Now, what is receivership? A lot of you probably hadn't heard about that until the last couple of weeks. Receivership is when a bank can no longer operate itself and the regulatory authorities come in and take it over. Once that happens, you typically have the trustee, in this case, the government, they will do one of two things. They will either first, and the most likely option is look to sell the institution. This happened a lot in 2008 to institutions that had problems. The federal government tried to find buyers for these institutions, and people came in and purchased them. Or if a suitable buyer cannot be found at the right kind of price that will make the obligations of the bank whole, sometimes the trustee will actually wind down the bank themselves, trying to recover as much as possible for the depositors in that situation. In this particular case, the regulators attempted to auction the bank only a day after its closure. There were no banks, though, that were interested in bidding. There was one institution that did, but their offer was declined, which then put the regulators in a huge panic situation because, once again, 97% of the deposits are not insured. So what does that mean? That means if the bank ultimately does have losses, the depositors are going to experience them because their deposits are not insured in this situation. And once again, think about who are most of the customers here. They're companies that are relying on this money in many cases to pay payroll. If the money was not there on Monday, one, a lot of companies probably wouldn't have been able to make payroll, but even if they had, the bigger problem would have been the contagion risk. The fear that other banks could see runs and then not be able to make payroll could have seen mass exoduses from small and regional banks. And we did see some mass exoduses from other small and regional banks, but I think it was far less than it would have been if what hadn't happened next, which was on Sunday, March 12th, the FDIC announces that all depositors will have 100% access to their funds. They triggered the systemic risk exemption because the FDIC can't do this normally unless they believe there is systemic risk to the entire banking system. So they invoked that clause, which allowed them to guarantee the deposits all the way up to what the individuals had in the first place. Now, a couple of important distinctions to make. First, was this a bailout? So first, the owners have not been bailed out in Silicon Valley Bank. People who own shares in Silicon Valley Bank have not received one penny, and I don't think they ever will. The group that is receiving support here are the actual depositors, people who had money deposited at the banks. So, we can agree or disagree on whether that was a good thing or not, but that is an important distinction here. This is not a bailout to the owners of the bank. This is specifically a shoring up of the depositors' money to make sure that they have access to it. And obviously it's way too early to say. Nobody knows the quality of Silicon Valley Bank's illiquid assets at this point, but there is a chance, if those assets are actually good, that there may not be a lot of money that the FDIC actually has to ultimately come up with. They may just have to be a liquidity bridge. It's too early to say, so we'll have to see if that ultimately comes out or not, but that is a distinct possibility. Silicon Valley as a company is likely to be done, and the shareholders are likely to get nothing, or at least very little, coming out of a situation like this. Now, the fallout. That is by far the much bigger thing here that's important to think about. So first off, the shaking of faith in small and regional banks. And we've already seen this. Literally the next day after, or I guess 2 days after Silicon Valley Bank was closed, Signature Bank, the third largest bank failure in the US, also ultimately occurred. We also saw First Republic have a lot of shareholders that ultimately decided to start withdrawing funds. We saw additional stress with Credit Suisse in Europe. And so we started to see this occur in several other banks, most notably amongst banks that don't have high insured deposits. That's where most of the activity was concentrated. But one of the things a lot of people aren't thinking about is this. So within the United States, there's this concept of systemically important institutions. Bank number 25 or higher is considered a systemically important bank. They have to live up to a certain higher set of standards for banks. As a result, they also share in some additional protections to help them in the event of a crisis. But if you're bank 26 or lower, you don't have those additional requirements, nor do you have those additional protections. And so if you're one of those banks, which there's a lot of them, there's like 8,000 banks below bank number 26, representing about 38% of the deposits in this country, you are probably wondering, I can't rely on the FDIC or the central bank to come in to protect me. So if there is a bank run, I've got to make sure that I have enough capital to do it so that people's faith is not shaken in my institution. What is one of the likely outcomes of that? We could start to see a lot of small and regional banks, as they get new deposits, not seek to loan that money out. For the next 3 to 4 quarters, by conservative estimates, that's what they would need to do to really shore up their balance sheet organically to be prepared if things get worse. And if that happens, the results of that could be really, really devastating. Because if you look back over the last really 3 years since COVID hit, approximately 50 to 60% of the bank lending activity has occurred from small and regional banks, from banks 26 down. So really the backbone of the recovery has been fueled and funded by small and regional banks. So this is probably honestly one of the most concerning components for me, because you could start to see a lot of banks in a lot of non-tech related areas start to get hit. Sorry, not banks, but companies in non-tech related areas start to get hit if they're not able to access liquidity and loans for other growth and expansion that they were ultimately wanting to do. And then the last thing, we think that we'll probably see an evaluation of the banking rules, specifically surrounding the FDIC insured deposit limit. And there's probably a whole host of other ideas that will be on the table. So a lot of other things we could talk about here, but I'll open it up for questions just so that we get to the things that are most of interest to you.
Thanks, Josh. I appreciate that. There is a lot of complexity here, and we certainly have a lot of questions that are coming in. Let's start out with this one. Obviously, SVB has not been the only bank that's been seeing negative news currently, and a lot of concerns related with Signature Bank, First Republic, Credit Suisse over the weekend. What's going on there? And are these indications that there's maybe a wider spread issue with the banking system? Is this going to be an issue that's potentially impacting more traditional consumer banks, that sort of thing?
Yeah, great question. So let me touch on the banks that have been hit, and then I want to talk about the structural problem. So First Republic Bank, 68% of its deposits were uninsured. Signature Bank, roughly 90% of its deposits were uninsured. So that's the common theme amongst the US banks that have been having problems. Most of the outflows have come from banks where people fear that they are exposed to loss because their deposits are largely not insured by FDIC. So that's the first issue. If you look at these institutions outside of that, they didn't have a lot of other issues. Maybe they had issues related to their bond portfolio as an example, but the biggest problem came down to the fact that they just had a lot of people wanting to get out all at once. And actually, before we move on, I want to actually touch on the structure because I think that's important. So let me actually move back here on the slideshow, Max, if that's okay. I want to go back to the structure of SVB's balance sheet because this is really key. One of the things we've got to understand here is that the bank structure we have today is inherently flawed. Why? Because look at SVB's balance sheet. There's $173 billion of deposits. If every single bank holder, not even if every single one, we didn't have to have every single bank holder come and ask for their money, and SVB couldn't honor it. Why? Because banks will make either less liquid or illiquid loans. Now, in SVB's case, were their loans, was the amount of illiquid things potentially disproportionate to what it should be? Sure. But a bank is always going to have a certain amount of loans to commercial mortgages, residential mortgages, business loans, lines of credit, things that they can't just sell like that. And as a result, with the fractional reserve banking system we have today, people can deposit money, collect interest, and get all of it back at once. Do you guys remember the movie It's a Wonderful Life? You got George Bailey. He's just gotten married. He's about to go on his honeymoon, and he sees the line at the bank, and he's like, shoot, there's a bank run going on. So what does he do? He goes down to the savings and loan. He begins to have conversations with the depositors. And you remember the one guy who's determined, I'm going to pull all of my money out. And George Bailey comes out and he says, look, fill out this slip and we'll get you your money in 90 days. That is the way banks used to be. You used to not be able to get all of your money all at once because they recognized that the bank was going to have to use some of the money for less liquid tools. Well, those regulations are gone. We no longer have to do that. And that's why bank runs can be particularly heinous in those situations, because fear can cause enough people to run to the bank to want their money. And the bank may have that much money in assets, but it's not in assets that they can give you cash for right now. And that's the issue. And that's really the issue with Signature Bank, especially with 90% of the deposits virtually uninsured. There was no way they were going to be able to cover it as well. And that's the same kind of problems we've been having with First Republic. Now, First Republic, for those of you who've not kept up with the news, has received $30 billion of deposits from 5 major banks. And those deposits are uninsured. So basically, they're injecting liquidity into the bank to try to help beef up the liquid portion of First Republic's balance sheet right now. And so that has helped to alleviate some of the fear. Although this morning we still see the share price has dropped precipitously still further. And so there's a question about whether or not First Republic is going to have to raise more money. In the case of Credit Suisse, this is a very different situation. So some of you may be more familiar with Archegos and capital management and some of the hedge funds that had bankruptcy problems. Or even maybe not bankruptcy problems, but large issues back in 2021. Credit Suisse was one of the predominant custody holders of those assets. And so they suffered some severe losses with several of those hedge funds. So this is a bank that had a lot of additional problems long before this situation happened. They had some mismanagement. There was a scandal where they had people spying on their competitor, UBS. And so all of these things already had them in a situation where people didn't have a lot of faith. Now you start to have these bank runs, and that only adds a lot of gas on the fire in that situation. So over the weekend, we did have a purchase. I hesitate to use the word negotiated because it was negotiated, but it was negotiated between the government and UBS. The shareholders of Credit Suisse did not get to vote. They were not represented in the way that they were legally supposed to. So that's actually one of the other more concerning side effects of the European side of this, is that the rule of law was basically completely abandoned in that situation. Shareholders were not able to negotiate for themselves. Not to say that, that may not work out for the best for us, but that is a concerning outcome coming out of that situation as well. So UBS purchased them for about $3.2 billion. And the hope is that that will provide some solidness to the system. Having said that, Credit Suisse's shares have still continued to decline, partially because of the low purchase price that was paid during that time.
Great. Thanks, Josh. So we're getting several questions related to kind of, should we be concerned about this? Is this something that we as investors or depositors should be concerned about? And one question connected to that would be, are there any banks or savings institutions that are not FDIC insured? And if that's not true, if they're all FDIC insured, what's the best way for us as depositors to determine, is my bank solid? And should I be concerned about that?
Yeah, great questions. So let's start off with being able to evaluate your bank. So first off, banks are required to be part of FDIC as part of that process. It's what brings stability, or it's supposed to bring stability to the banking system in the first place. So you'll notice common threads with the banks that are having problems right now. As I mentioned, high percentage of the deposits being uninsured. That's an area that I would generally try to avoid. Having said that, though, notice what the government has done up to this point. They have come in and they've made sure that the depositors are whole, specifically using FDIC and then ultimately through central bank support and other bank support. The banking system does not want a bank to go under. because if they do that and depositors have losses, it will be devastating for the entire industry. That's one of the reasons why JP Morgan, Citibank, Bank of America came in and put $30 billion without charging anything to First Republic. That was not out of the goodness of their heart. They have a vested interest in making sure that the banking industry is still there. So understand that our central bank and the rest of the banks have a strong interest in not allowing depositors to lose funds. Now, that doesn't mean that they're guaranteed to not do so, but they have a strong interest in not letting that happen in the first place. But if I was going to avoid institutions, I'd be avoiding institutions that have high uninsured deposit numbers, because the real thing you're really trying to avoid is the bank run. That's really what you're trying to avoid. You're trying to avoid people's fear, because people's fear is what is causing most of the problem here. And so if you can avoid groups that have high uninsured deposit numbers, that would be one thing. Another question would be, what percentage of the deposits are in less liquid securities or illiquid securities versus liquid ones? The general rule of thumb that I give to clients from a banking standpoint is our recommendation is to recommend to bank with one of the top 4 banks: Morgan, Bank of America, Citigroup, or Wells Fargo. At the end of the day, these are systemically important institutions. Our belief is that the central banks will not allow these banks to go under, that they will always make sure that depositors' money is made whole. We feel like it's the least risky option that's out there. So that's always been our general recommendation when clients ask us what's our opinion on things like that.
Okay, great. Along those same lines, what are your thoughts on local credit unions? And is there any difference between a bank and a credit union when it comes to the security associated with that as a depositor?
No. So once again, small generally brings more risk, because if you got a small bank and they've got, a couple $100 million of depositors and it goes out of business, as an example, will a bank, will the FDIC, work through receivership and other things like that to try to work through things? Yes, but there's not nearly as much visibility. There's not as much systemic risk. And so first off, the ability for the FDIC to declare a systemic risk gets smaller. Now, if it's in concert with a bunch of other banks, potentially maybe you get lumped in, but smaller institutions inherently have more risk in a situation like this. They have the same problems, which is that they make some loans, like they buy government bonds or mortgage-backed bonds that are liquid, but they also make illiquid or semi-liquid loans. That's the fundamental problem. If you have enough people run for the doors, you're going to face the same kind of issues. So I know we all like the kind of local feel of some of these institutions. We have to recognize, though, that they are susceptible to the same issues. Now, if you have a really well-run group and they have a lot of confidence and the people don't really fear anything, then that can prevent something like that from happening. But you're making a judgment on the bank's depositors' psychological health, and that's not exactly an easy thing to do.
And it is true that those credit unions are FDIC insured as well. Is that correct?
I actually do not know that, so I can't speak for certain on that.
Okay. Let's move on to a little bit of a different topic, which is in connection to receivership. Let's take, for instance, UBS, which recently took over Credit Suisse. In that type of situation, or maybe whichever entity ends up taking over SVB, does that new institution become liable for the shortfalls or debts of the old company that they purchased?
An excellent question for whoever asked that one. That's a really good one. The answer is it all comes down to what was negotiated. So coming out of 2008, there were a lot of banks that part of the negotiation said, we'll buy this institution, but only if the government will buy some of the really bad assets off of the bank's books. That was one of the TARP program, as an example. And so the same thing is true in these situations. Part of a receivership deal is the banks are negotiating the price and the terms at which they accept the actual purchase of the goods. And so, like as an example, in the case of UBS, they were negotiating, and I don't know what the final negotiation is because I don't think it's been made public yet, but one of the rumors that have been thrown around was that the Swiss government would ultimately eat any losses associated with Credit Suisse's operations for a period of time and potential lawsuits. So every situation is different based on what the bank ultimately negotiates. And obviously the government doesn't want to give away any more than they have to, because that's more taxpayer money that has to go, or maybe in a central bank's case, more central bank funds that have to go towards paying for those losses. So it really is going to come down to a case-by-case basis, and how good of a bank and how good of a balance sheet that bank has, and how toxic those loans are perceived to be on those books.
Is it fair to say that, and this kind of speaks to this very issue, I think it's true in the case of SVB, that this is more of a liquidity issue than a solvency issue. And that's what you were kind of getting at earlier. It's unlikely that there's going to be, well, we don't know really until we figure out what these loans, what the health of these underlying loans are. But
yes,
it's very possible that the FDIC and the federal government end up not, or whoever it is that takes over this new entity, they're probably not going to have to come up with a lot of additional capital, because it's more of a liquidity problem than a solvency issue.
Yeah, once again, the fact that SVB only had, $42 billion, $43 billion of liquidity was what caused the bank to have to get closed. They had $158 billion of additional assets on the books, but they couldn't sell them. These are assets that would have taken weeks or months to sell. And so that's what caused the problems at the end of the day. That's one of the reasons why they tried to raise another $2.25 billion, because they needed more liquid assets. And so we obviously can't know for certain the quality of SVB's $158 billion illiquid portfolio, but assuming that they have fairly good underwriting, there's a chance that those assets could be managed by either a trustee like the FDIC or the Federal Reserve through receivership, or ultimately be sold to another bank and they manage through it, and they could come out flat or even positive in a situation like that. Now, obviously, they had the $1.8 billion loss from the long duration mortgage-backed securities and the treasuries related piece, but that's, once again, relatively small. We're talking about a 1% loss on like the total assets of the bank at this point. So there could be bigger problems laying underneath the illiquid portfolio, but if it's been actually really good credit underwriting in those situations, it's possible that this might not be that big of a loss. And definitely the bank closure has been a liquidity problem more than anything else, which is exactly why these other banks have put $30 billion into First Republic. They think that First Republic at least had a chance, and maybe still has a chance, to get through this without having receivership, but they need money on the liquid side to make it through until people start to calm down.
Excellent. And just so you guys know, we've gotten clarity on FDIC coverage or backing for credit unions. FDIC does not cover them. They are covered by their own insurance through something referred to as the National Credit Union Association, which provides coverage in a similar number or in a similar amount to FDIC. So they have their own coverage, it's just not connected to FDIC specifically. So we're up against our stop time, which is 4 o'clock. We've got a couple other questions that I would like to go ahead and cover. And if any of you guys need to leave, feel free to do so. We are recording this, so you're welcome to come back and listen to those few other questions if you need to wrap things up. But just two more that we'll cover before we close out. And the first is, as it relates to FDIC covering the basically providing the liquidity that we're seeing here. They've essentially noted that they'll make everybody whole. And let's say in the end, after the dust settles, there's $10 billion that's a shortfall. Who covers that? Where does that money come from? And what does that process look like?
Yeah, so the FDIC, so it will, in this case, FDIC is the one that is come out to say that they will guarantee it. And so at this point, based on that declaration, and we obviously don't know if there's been any other, backroom deals between between the Federal Reserve or anybody else, but assuming that they're going to be the ones that come up with it, it'll come from their insurance deposits. They have about $122 to $130 billion in the FDIC fund to cover bank shortfalls and things like that. So that's where those funds would ultimately come from. I do fully suspect that as a result of what's happening right now, there will be efforts as part of regulatory change to try to increase the size of that fund and the dues that have to be paid in order to make that fund more sizable to handle larger problems if they do come in the future.
Okay, great. Next question. Could this and other issues that we're seeing in the marketplace currently be the catalyst that the central bank has been looking for potentially to create a central bank digital currency and potentially see that implemented here in the US?
Yeah, good question. So I think the answer is no. So for a couple of reasons, the issue that we're dealing with here is a crisis of faith. It's a crisis of, hey, will my money actually be there at a banking institution? And so digital currencies inherently are viewed with a large amount of skepticism by the broader consuming public at this point. And so I don't think that this is likely to be used as an environment to try to push for that. I think if there was ever going to be an argument for the use of a digital currency, I think the provocation behind that would probably be more likely to come from a way to try to stop, money laundering, or a way to make sure that people are taxed, getting taxed their fair share so that everything is traceable, or potentially to try to mitigate inflation. Maybe that would be an argument that could be used. But the environment that we're in right now, to be frank, digital currencies are to some extent part of the problem. That was at least a contributing factor because, Signature Bank, but even before Signature Bank, the first bank failure here was Silver Lake, which was predominantly a crypto-based bank, completely went into receivership, had a lot of problems there. And so they were actually the first domino to fall in this whole situation. So I don't think so. I think there's other reasons that someone could make to argue for that case, but I don't think those are going to be the situation right now.
Okay, great. And I have one last question that came in that I think is valuable for us to cover here as we wrap up, which is, how does hedging work in connection with what we're looking at here? And would that have helped avoid this problem?
Absolutely, yes. So traditional banking habit is, if you are going to take longer duration risk for mortgage-backed securities or treasuries, you will use hedging in the event that you are wrong on interest rates moving up, because you don't want to get hit in that situation. So larger banks would not have had these longer duration maturities and without having hedging in place. And because of that, that's what sparked the initial fear. The initial fear, once again, Wednesday is when all this really started. Wednesday comes around and Silicon Valley Bank announces the $1.8 billion loss from those sales, which then causes them to have to raise an additional $2.25 billion of liquidity to try to shore up their balance sheet. And then literally people lose all faith at that point. Now, is it possible some other string of events could have happened that could have still caused it? Yes, because once again, this organization only had $44 billion of liquid capital. So if there had been something else that had happened that had caused people to lose faith, you could have still seen a bank run potentially that would have caused a problem here. But the initial instigation that caused this whole thing was those treasury losses being announced. It wasn't until that sale had to happen and the losses were locked in, that's when the fear started. So absolutely, at the very minimum, I think it would have calmed things down significantly, and potentially we might not have seen the issues unfold like we have at this point.
Excellent. Well, that's all the time that we have for today. And I believe we were able to address almost every question that came in. So we're grateful for all the time that you guys spent with us today. Thank you, Josh, for your insight and expertise. We look forward to answering other questions that you guys have. If you have additional thoughts or other things that you'd like to cover with us, please do reach out. We would love to hop on a call or respond, communicate by email if there's some additional information you'd like us to cover there. But be keeping an eye out for the recording of this. If you'd like to share it with anybody, please feel free to pass this along to anybody that you might believe could have an interest in this topic. So again, thank you guys for being clients of ours, and we look forward to talking with you soon. Have a great day.